Let's take a look at the cost flows in a job order costing system and prepare journal entries to record those costs. First, let's review some key definitions. Raw materials include any materials that go directly into the final product. And recall our raw materials consist of two types. We can have direct materials, and those are materials that can be easily and conveniently traced to the product. And any other materials that we use to make the product that can't be easily and conveniently traced to the product will be classified as indirect materials and become part of manufacturing overhead. Work in process consists of units of product that are only partially completed, and they're going to require further work before they're ready for sale. Our finished goods inventory consists of completed units of product that have not been sold to customers. And then our cost of goods manufactured includes the manufacturing cost associated with the goods that we finished during a particular period of time. Let's look at a flow diagram. So we have raw materials, and those raw materials flow directly into work in process if they're direct materials. Otherwise, they become part of manufacturing overhead. Our direct labor flows directly into work in process, and we will apply manufacturing overhead using our predetermined overhead rate and some actual activity level. After our goods are finished, they will be transferred from work in process to finished goods, and once the goods are shipped, those costs will be matched with the revenues they help to generate by a journal entry that takes them out of cost of goods, takes them out of finished goods, and puts them into cost of goods sold. And recall, any selling and administrative costs, those are referred to as period cost, and they flow directly to the income statement. In the upcoming slides, we're going to look at the transactions in a T account and journal entry form that capture the flow of cost in our job order costing system, and we'll look at a cost flow diagram. So first, if we looked at a T account for raw materials, our beginning balance and any purchases will show up as debits in our raw materials account on the left-hand side of our T account. And when those materials are issued to production, we will credit raw materials and either debit work in process if they're direct materials, or debit manufacturing overhead for indirect materials. The Smith Corporation had $5,000 in raw materials on hand, and during the month the company purchased $45,000 in raw materials. We would debit raw materials and credit accounts payable. If we looked at a cost flow diagram, notice we've got product cost and we've got period cost above our income statement. If we were to look at our cost flow diagram, we would have our beginning raw materials balance. Then we would record our purchases as coming into the left-hand side of a box. It would be a debit to our T account. Next, we're told on October 3rd, Smith had $43,000 in raw materials requisitioned from the storeroom for use in production. Of these, $40,000 were direct materials and $3,000 were indirect. Recall again, we want to credit raw materials because we're using them up, and we will debit work in process for the direct materials and debit manufacturing overhead for the indirect materials. Let's take a look at our flow chart. There's the issuing of indirect materials. They will be a credit to raw materials and a debit to manufacturing overhead. And our direct materials will be a credit to raw materials and a debit to work in process overhead. Labor costs will end up crediting salaries payable or wages payable, and direct labor, recall, flows directly into work in process, and that will be a debit to work in process. And indirect labor will flow directly into manufacturing overhead as a debit. Let's again take a look at our flow diagram for some costs for our company, which we're told during the month had $35,000 of direct labor and $12,000 of indirect labor. So again, notice the debit for work in process of $35,000 and a debit to manufacturing overhead for $12,000. And then again, the credit will be to wages payable or salaries payable. On our flow chart, the direct labor flows directly into work in process, again on the left-hand side of the box, which would be a debit to our work in process T account, and the $12,000 will flow into manufacturing overhead. Other overhead costs will be recorded as a debit to manufacturing overhead, and a credit to either cash or accounts payable. Let's assume during the month the company incurred $1,700 for utilities, $2,900 in depreciation on factory equipment, and $1,000 in property taxes on the factory. So we have going to debit manufacturing overhead for the $5,600. We'll credit utilities payable, credit accumulated depreciation for the $2,900 in depreciation expense, and credit property taxes payable for $1,000 for the taxes on our factory. Let's go ahead and look how those costs will show up on our flow diagram. And you can see that debit shows up on the left-hand side in the manufacturing overhead box, or left-hand side of the T account. The next step is to apply manufacturing overhead to the jobs. And recall, we apply manufacturing overhead using our predetermined overhead rate multiplied by some activity level. And we will credit manufacturing overhead and debit work in process. Also, if the actual amount of overhead does not equal the amount that's applied, we'll have an adjusting entry for our over or under applied overhead at the end of the period. We'll take a look at that a little bit later on. So on our flow chart, we multiply our 5,000 manufacturing hours, machine hours, by our $3.50 predetermined overhead rate, and we get applied overhead of $17,500, and that will be a credit to manufacturing overhead and a debit to work in process. And in terms of the journal entry, again, it would just simply be the debit to work in process and a credit to manufacturing overhead. Recall, non-manufacturing costs, also called period cost, are not assigned to individual jobs. They don't flow through work in process. In fact, they don't show up on the balance sheet at all. They go directly to the income statement, and they're expensed in the period in which they incurred. Examples would be the salary expense for employees working in marketing, selling, and administrative capacity, advertising expenses incurred during the period. Let's go ahead and take a look at some of those. Let's assume during the month Smith incurred but has not yet paid sales salaries of $2,000 and advertising expenses of $750. We would debit sales salaries expense $2,000, advertising expense $750, and we would credit payables for like amounts. Let's go ahead and take a look at our flow diagram. On our flow diagram, we can see that our period costs end up directly on our income statement. They never become part of the work in process, raw materials, or finished goods balance sheet accounts. Once we've completed units, we're going to need to transfer those units. We'll take them off the shop floor and move them into finished goods. So the physical flow will be moved off our production floor and into finished goods, and we'll also need to record journal entries to transfer those costs. And that journal entry will involve a credit to work in process and a debit to finished goods. Let's assume during the period Smith completed jobs with a total cost of $27,000. We'll move those costs out of work in process with a credit and into finished goods with a debit of $27,000. Let's go ahead and take a look at the flow diagram. On our flow diagram, as those costs move, we will end up with a $27,000 credit to work in process and a $27,000 debit to finished goods inventory. Finally, once we sell or ship those units to a customer, we will take them out of finished goods with a credit and move them into or match them with the revenues they're generating with a debit to cost of goods sold. Let's assume that's $27,000 in finished goods we have shipped to a customer on account, and the selling price was $43,500. We will credit sales for $43,500 and debit accounts receivable. And that's the revenue side of our transaction. And now we want to match our costs with that. So we will credit finished goods for $27,000 and debit cost of goods sold for $27,000. And we can see on our flow diagram the costs coming out of finished goods and into cost of goods sold. Let's go ahead and finish off our flow diagram. Let's assume we were given a little bit more information. Let's assume that we are told that beginning work in process inventory was $10,000 and beginning finished goods inventory was $16,000. Let's record those on our flow diagram. The 10,000 beginning finished work in process inventory goes on the debit side, upper left-hand corner of our box. Okay. And our beginning finished goods shows up in our finished goods inventory. Our next step, we know both sides of our boxes have to equal. And we can see that our total costs that we have to account for is $102,500. That's our beginning work in process, plus our direct materials, plus our direct labor, plus our applied overhead. So the total cost that we have to account for is $102,500. And we know both sides of our box are going to have to equal each other. So we can go ahead and calculate what would have been our ending work in process inventory. That would be our total cost of $102,500 minus our cost of goods manufactured, that was the $27,000. So we have ending work in process would have been $75,500. We can do a similar calculation for finished goods. We'll take our beginning inventory of $16,000, add to that the $27,000 in cost of goods manufactured. So we've got $43,000 in goods available for sale. Again, both sides of our box have to equal each other, so we know the right-hand side will also have to equal $43,000. So we can make use of that information to calculate what would have been our ending finished goods inventory. And notice, it's exactly equal to our beginning finished goods in this case because the cost of that one job that we finished was transferred into finished goods and then shipped to a customer, so it was transferred out of finished goods and became part of our cost of goods sold. Let's continue on. A little bit more information. Let's go ahead and take a look at our overhead accounts. And we can add up both our actual and applied manufacturing overhead. And our actual overhead was $20,600, but we only applied $17,500. And recall the applied overhead, that was our predetermined overhead rate of $3.50 per machine hour multiplied by our 5,000 machine hours. So we've applied $17,500 in overhead to work in process, but incurred $20,600. If this was the end of the year, we would need to add up both sides of our account, and we would find that we had underapplied overhead of $31,000. This means that our work in process would have been too low by $3,100. And since costs get transferred from work in process to finished goods would have been too low by $3,100. And since cost and finished goods ultimately get transferred to our income statement as cost of goods sold, our cost of goods sold would have also been too low by $3,100. Our journal entry to zero this out at the end of the year, in this case then, would be a credit to manufacturing overhead and a debit to cost of goods sold for $3,100. This will increase the cost of goods sold on our income statement from $27,000 to $30,100. We can then calculate our gross profit, which would be $13,400. That's simply sales minus our cost of goods sold. And finally, our net income, which is our gross profit minus our sales salaries of $2,000 and our advertising expense of $750.